Hello, everyone. Knox Ridley here, portfolio manager of the IO Fund. And this is our weekly broad market update where we look at levels, provide context, and where we think the market is going. The benefit of this is you get to see how we manage a growth portfolio in real time, both with fundamental and technical analysis helping us out. And so I wanted to start off with some free information that we provided back in August 10th. This is in our free blog at the IO Fund website. And on August 10th, we were talking about a warning sign with the uptrend that was developing off the June 16th low. And specifically, we were only seeing 3 waves off that low. And this is a warning sign. We use this to actually raise quite a bit of cash and look for a place to put our hedge back on. And we provide this information in real time with real-time trade alerts to all of our members. And if you've been with us over the last couple of weeks, we've been adversely looking for some kind of a meaningful low. And this morning, based off the price action that we were looking for, we got a capitulation low, in our opinion. And once the S&P 500 went below 3,500, we took half of our hedge off, logged a really nice gain there, and went on a buying frenzy. We bought 2 semiconductor plays and a cloud play that we've been targeting. And one of those semiconductors was up 20% in one day. And once again, we send out real-time trade notifications of what we're doing in real time and daily updates like what you're about to see, just preparing all of our readers for what we think is happening next in the market. And so what we're going to do today is go over what it is we were seeing on a technical side and what we think might be playing out next. So first and foremost, last week we talked about this signal. I'm going to go a little bit deeper into it. We were seeing some really extreme oversold conditions. This is the S&P 500 on a weekly basis. Each bar represents a week's worth of price data. And this is the composite index. This is a momentum indicator that I prefer to use. And what we were seeing was this green band represents extreme oversold conditions that we don't see very often. And as you can see, price was making a lower low while the composite index was making a higher low. So we're seeing a weekly divergence, and it was moving back into this extreme condition. And also, and this is important, the spread between the moving averages was actually bullish. And so I went back in time to see when have we seen this pattern play out in the past, where we've seen this kind of bullish divergence with a positive spread on the moving averages. And the last time that we saw this was back in 2009. Same pattern playing out. As you can see, we've made from extreme oversold conditions, we moved back into oversold conditions with a positive spread, with price making a lower low and the composite index making a higher low. And the last time we saw this pattern play out before this was in 1982. So it's a very rare pattern. The last 2 times that we've seen it marked some kind of a meaningful low. So this coupled with this pattern right here, this is a DeMark signals. And, I know the purists out there probably will disagree with how I use it. I look for it as kind of an addendum for oversold conditions. And when you see kind of a DeMark, a 9 or a 13, that's signaling that we're seeing some pretty extreme selling conditions, which sets up for a bullish reversal, right? And the last time that we saw a DeMark 9 on the monthly chart was back in the 2009 lows. So once again, like I said, just technically speaking, we're seeing some extremes here that are pretty rare. So when you couple that with the bearish sentiment out there, there's a lot of metrics to use. This is one that I like. It's the AAII investor sentiment reading that comes out pretty regularly. And this is the percentage of the people involved in that survey that are bearish. And last week, it was at 60%, almost 61% were bearish, expecting bearish results over the next 6 months. And in order to find a more bearish reading, you have to go back to literally the low, March 5th, 2009, to see readings that bearish. And so once again, we're approaching pretty extreme conditions and with sentiment as well. And any signal you use to measure sentiment, they're showing about the same thing. Everybody is bearish right now, and the positioning in the market is showing that. The other thing that had us getting ready for some kind of a reversal was just the divergences that we were seeing. So when you're close to a big low and a big high, markets start to diverge. When everything's moving in one direction at the same time, that's a trend you want to be a part of or away from, if it's going down. But when we start seeing these divergences, it's telling you that something is brewing, that a reversal is likely happening. And so what you're looking at is the iShares Momentum Factor ETF. It's just a ETF tracking high beta stocks. And this ETF made a low on September 30th and gave us a nice 5-way pattern off that low. The S&P 500 in comparison in blue, it made a low today, while the Momentum ETF made a higher low, right? So this is the kind of divergence that I like seeing playing out, right? And just a few more that we were tracking. The Dow Jones Transports, this has been leading the bear market pretty much since 2020, late 2022. It also made a low around the same time, while the S&P made a low today and the transports made a higher low. So once again, this divergence is important for trend reversals. And Caterpillar, there's a lot of stocks that are important to the market. I track Caterpillar. I think it's a really important stock for tracking the global economy. And it had a huge divergence. So it gave us a nice 5-way pattern. Didn't even come close to making a lower low as the S&P did today. So, and we were seeing the same thing with small caps, with financials, with biotech. All of them were diverging from the S&P 500, big tech, and semiconductors. And so to us, the question is which markets are leading? And when you're close to a major low, seeing those kind of oversold conditions, the likelihood that you're seeing a trend reversal is relatively high. And so we were expecting a turnaround, which is pretty much what we got today. We'll have to see if we get follow through tomorrow, but we'll go into now what it is that we think could be playing out in the broad market. So just a refresh and an update on the bigger picture, which I think is important, is I think that this pattern, this bear market pattern, there's one of 3 things I think is playing out, or variations of these things playing out. And the first, this is what I think is playing out, my primary account, or our primary count, is that we have a 1, 2, 3, or ABC, right? A 3-wave move down, and that marks the end of the first major leg in this bear market, June 16th. And I think this pattern playing out from there is what we call an expanded flat correction, right? Which is 1, 2, 3 up, 1, 2, 3 down, where the B wave breaks below the start of the A wave. And what gives way to that is a powerful C wave that usually goes above the end of that A wave right there. So that would take us to 4,200 to 4,500 in the S&P 500 over the next few months. We'll have to see how it plays out. And then what follows that is your larger C wave, which you can call the real bear market, going into 2023. The important thing is you don't really have to make this determination right now. When we start getting up into these levels, that's where you start making the determination of what you think is playing out. But what we're trying to do is just capture the next right move, not capture the next long-term move, because these can change with information that comes out. All right. The next scenario that I think could be playing out is what we're going to call our green count, which is that what we just saw was the low of a very complex and deep 4th wave, with a 5th wave pattern taking us to the S&P 500, 52 to 5,800 into 2023, maybe 2024. So this would be setting up for a really nice 2023. And as improbable as that seems right now, there's a reason that we follow price. And if you ever find yourself in the market saying things like, this market doesn't make any sense, whenever we saw the COVID correction happen, that was a big example of this market not making sense. We're seeing horrible, off the charts economic data, yet the market keeps going higher and higher and higher. And the reason is the market is pricing in future data and future probabilities 6 to 9 months out, and it tends to be right. Which is why it's so important to follow price. And so if this market actually starts signaling that it wants to do this, we're going to follow this pattern. The next scenario is this one right here. And that would be that this was the end of the first leg of the bear market. This is the end of the second leg of the bear market. And we're going into that C wave down sooner than later. And this would see a move up into the 3,900, maybe 4,000 range of the S&P 500 before failure. And we gap down and go and probably finish this bear market in, mid 2023. I have a lot of problems with this scenario. for one, this B wave really didn't really retrace that far to be considered a legit B wave. Typically, look, it didn't even go to the 50% retrace. Typically, they retrace a lot of the down move in the A wave, and they also are at least half the length and time of the A wave. This isn't even a third of the length. So I have a lot of problems with this count, but I have to put it up here just to manage risk. And so you may be saying, okay, so you're saying the market could go up or could go down, and that's not what we're saying. Of course, that could be happening, but there's a pattern playing out which we're trying to identify in real time. But most importantly, we're giving you levels to be cautious in. So your first level is 3,900, 4,000. The really big one would be 4,200 to 4,500 in the S&P 500. And if we break above there, no matter what anyone says, the odds really favor us pushing into a bull market into 2023, targeting these levels. So these are giving you some really specific levels to start managing risk around. And so there's also more information that we can use. So what will help us determine whether we're going into the blue and green count versus this bearish red one? And so what we're looking for is this move off the low. If it's the red one, then what we're looking for is a 3-wave move, right? And if it's the blue or green, we're looking for a 5-wave move. And so what this candle pattern is telling us can help us determine what's likely going to be playing out, okay? But if we get 3 waves off this low and it starts failing around 39, 4,000, that's when you raise cash, that's when you get cautious, that's when you put on your hedges. But if we get this really nice 5-wave move that blows through here, then we know this is our next level to start getting cautious. And so if we take a look, let's see here, at this corrective pattern. So first and foremost, these tan markers mark inflection points. We do a lot of cycle work to help us look for moments that the market will likely have a reversal. And we're 1 day away from our next one. And we were expecting somewhat of a low going into this, which is another reason why we were getting a little more aggressive on the buy side today. But what I'm showing you here is that we have a very full corrective pattern in place. A, B, C down with 1, 2, 3, 4, 5. Could we make it a low? Of course we could, but we would find that as an opportunity to remove the rest of our hedge and to buy even more positions. So what I want to show you here is we have a full corrective structure in place, which is important. But if we take a look at what happened today, go to the 5-minute chart. So this is what you call a key reversal, the bar, where we actually started gap down and then finished way up. You can call it a bullish engulfing candlestick pattern on very heavy volume that really engulfed a lot of the move that we saw the last couple of weeks. That's important. These big reversals tend to be dramatic, and this candle pattern, which you really can see on the daily chart, is really important. You can see how big that is right there, and it's engulfing the last 3 trading days on very heavy volume. But the pattern off this low today is a pretty distinct 5-wave pattern: 1, 2, 3, 4, 5. And so what we're looking for tomorrow is probably a retrace back into the 3640, 3590. And if we can retrace and hold this zone, then break out above the high, which is about 3685, our hedge is coming off and we're going to start buying more stocks. If we go above 3745, then the odds really favor that another low is just not going to be happening. But if we fail here and then break below 3565, then our next level down is 3345. And I would expect that to be done on probably lower volume and lower momentum, setting up a pretty good buying opportunity, another buying opportunity into this market as we get this reversal underway. But so far, we're starting off really good with a nice 5-wave pattern off that low. So that is very promising. We'll have to see how tomorrow plays out. But in terms of supporting markets, which we look at quite regularly, let's take a look here. There we go. If we take a look at long-dated bonds rates, we're tracking TLT, which is long-dated bonds. So as it goes down, rates go up. We didn't quite get the reversal we were looking for today with equities, right? And so the next level down is 96, then 91. And it's really interesting what's going on right now. We talked about last week that who's buying treasuries, who's going to be buying treasuries right now. China, they're net sellers of our debt. Japan just started selling as well. And those are the two biggest buyers of our debt. And so if we go no bid in bonds, then we could really see the bond market start moving down even more so. And at some point, rates going up would just be too much for the debt load in the US. And that would start causing some pretty severe problems. Basically what happened in England would likely happen here in the US, where the Fed comes out and reverses course and starts buying long-dated bonds, being the buyer of last resort in order to keep rates, basically low to fund our current, sovereign debt situation. So it's really interesting what's going on in rates right now. But that's something to watch right now. The US dollar, which has been, in my opinion, the most important supporting market of the equity market, we saw a nice divergence, right? So it's actually moving inverse. So as it goes up, equities have been going down. This is the S&P 500, and this is the DXY dollar index right here. And it made a lower high while the S&P made a lower low. And it just broke below this key support. We really need to see sellers step up and take us down below this 112.40 range sometime tomorrow or into Monday. And if we can do that, then that's going to further signal that our trend reversal is underway. So anyway, that's what we're looking at right now. We saw some very positive signs in the market today. We want to see follow through as always. And we hope that helps you out. And, if you like what you see, please sign up to our YouTube channel. We're going to do a couple of these each week just to provide context of what's going on in the markets. And we thank you.